Hello and welcome. My name is Jenny, and I'm an avatar created by Uniserve to break down what customs valuation is, why it matters, how it's calculated, and the evidence required when using the UK's most common valuation method. Let's get started. What is customs valuation? Customs valuation is the process of deciding the value of goods at the border so that customs authorities can calculate import duty, import VAT, trade statistics, compliance and audit data. In simple terms, it answers the question, what is the customs value that duties and taxes should be based on? The customs value affects how much duty you pay, how much VAT is charged, how the trade is recorded in national statistics, and whether your declaration will pass audit checks. A correct valuation avoids costly delays, penalties, or reassessments. Most countries, including the UK, follow the WTO agreement on customs valuation, which sets out a globally recognised system for determining customs value. The primary rule? Use the transaction value, the actual price paid or payable for the goods. That brings us to the 6 valuation methods. These methods must be used in order starting from method 1 and only moving to the next if the previous one cannot be applied. First up, we have method 1, transaction value. This is the actual price paid for the goods sold for export to the UK and is the most commonly used method. Adjustments may be added for things like freight, insurance, royalties, and certain commissions. It's important to note that the most import declarations we submit use method 1. Next up, we have method 2, transaction value of identical goods. This is used when the value of truly identical goods imported at the same time is available. Method 3, transaction value of similar goods. Used when the goods aren't identical but are similar in characteristics and function. Method 4, deductive value, which is based on the UK resale price minus costs such as profit, transport and duties. Method 5, computed value. This is calculated using the cost of production, labour, materials and profit in the country of export. And lastly, method 6, the fallback method. This is a last resort, flexible method using reasonable means consistent with WTO rules. Here's an example of a customs valuation. If a company imports electronics with an invoice value of $10,000 but pays $1,000 for freight and $500 for insurance, and the customs rules state that cost, insurance, freight value is used, we can break it down to a customs value of $10,000 plus $1,000 plus $500 equals $11,500. And if duty rate is 10%, then customs duty is $1,150. What must appear on an import declaration? On the import declaration, such as a customs entry, import declaration form or single administrative document, the importer must declare invoice value, currency, freight and insurance costs, Incoterms, and the customs valuation method used. In the UK, method 1 is standard, but HMRC requires evidence to prove that this transaction value is legitimate. You must be able to show 4 key things. Number 1, there was a genuine sale for export to the UK. 2, the goods imported match the goods sold. 3, there are no disqualifying conditions. 4, the buyer-seller relationship didn't influence the price. Let's break each one down. Number 1, there was a genuine sale for export to the UK. Evidence includes commercial invoice, buyer-seller details, goods description and quantity, price and currency, Incoterms and payment terms, purchase order or sales contract. 2, the goods imported match the goods sold. This proves the sale and shipment are connected. Acceptable evidence is bill of lading, airway bill CMR, packing list, import entry, export declaration, if applicable. 3, there are no disqualifying conditions. Method 1 cannot be used if the sale is restricted or influenced by special conditions. You must show No restrictions on the use of the goods. No obligations that affect the price. No unquantified proceeds going back to the seller. Evidence often includes statements from the importer or seller, contract terms confirming unrestricted ownership. 4. The buyer-seller relationship didn't influence the price. If the parties are related, you must prove the price is still commercially normal. Evidence could include comparison to sales made to unrelated buyers, transfer pricing documentation, HMRC valuation rulings. If the parties are unrelated, a simple declaration is enough. Next, you must show evidence for any additions or deductions. Additions include commissions except buying commissions, containers and packing, assists, free materials or tools provided to the seller, royalties or license fees, transport and insurance up to the UK border. Deductions include post-import transport, UK installation costs, UK taxes. And common documents include freight and insurance invoices, royalty agreements, cost breakdowns, forwarder invoices. Take a few moments to view what HMRC expects in a valuation file. There are times when Method 1 must be rejected. This is when there is no sale, consignment, loan, lease, or gift. The price isn't clear or verifiable. The relationship affected the price, and the sale includes conditions that can't be quantified. If Method 1 fails, you must move sequentially to Methods 2 to 6. By understanding customs valuation, especially Method 1, you can submit compliant declarations, avoid penalties, and ensure smoother import operations. For further guidance, please contact the Uniserve team at inquiries@customsinsights.co.uk.